Bonds are one of the most common forms of investment. A bond is a loan given to a company or government by an investor. For example, the city of Liège would like to build a new football stadium. However, it needs funding and decides to issue bonds to raise the money. Each bond issued is a 10,000 euro loan that the city promises to pay back in 10 years. To make this bond attractive for investors, the city will pay an annual interest rate of 5%. This is called the nominal rate. Let's look at an example. Oliver is an investor. He speaks with his private banker and buys a bond worth 10,000 euros. Every year, over 10 years, he will receive 500 euros from the city of Liège in interest. The interest is also called a coupon. After 10 years, he will be repaid in full that 10,000 euros that he lent at the start. In 10 years, he will have earned 10 times 500 euros, i.e. 5,000 euros more than the amount originally invested. This is a good business deal for him and the city of Liège, which will be able to build its stadium. Bonds are often considered a more predictable, more stable form of investment than shares. But they usually offer lower returns. That is why they are generally used for the purposes of protecting and diversifying a portfolio. Naturally, like all investments, bonds are not risk-free. For example, the issuer may not be able to repay the money. This is known as the risk of insolvency or default. Most governments are considered reliable issues, so they issue bonds with a lower return. Corporate bonds generally pose a high risk of default because the companies may go bankrupt, for example. In such cases, this may lead to the total loss of the amount that you invested in the bond. Corporate bonds therefore offer high returns. So the higher the risk of default, the higher the return. But the risk of capital loss is high. There is also the risk that your bonds lose value before reaching maturity. This could happen, for example, after a rise in interest rates. In this case, if you would like to sell your bonds before the maturity date, you will have to accept a price that is lower than the purchase price. Your private banker will gladly explain this relationship between the interest rate and the bond price in more detail. Generally speaking, bonds offer the option of protecting your capital while generating revenue. Combining shares and bonds is therefore very attractive for reaching an investment objective. As bonds evolve differently to shares, they can help to increase or protect your portfolio's revenue. This, in simplified terms of course, is how investors use bonds. If you would like to know more about bonds or other forms of investment, we are here to help you.